Welcome to the second part on the series on PPE. In this video, we will cover timelines. The reason why we're covering timelines is because it's very important for you to be able to draw a picture of events and transactions. And this is important so that you can understand what is going on in a question. The key thing to train your eye to look out for are salient dates, the date acquired as well as the date that the year begins and the date that the year ends. If there is a tax change, be aware of it. Okay. So the following information relates to ABC Limited, a company that produces wooden roof trusses. All plant was purchased on 1 Jan 04 for 500,000 rands. The depreciation policy, which has remained unchanged since acquisition, is the straight line method over 5 years. The plant is estimated to have a null residual value at the end of its expected useful life. Okay, then we skip a paragraph and we'll come back to it in another video. On 1 July 06, plant with a book value of 140,000, tax value of 75,000 was disposed of at a profit of 50,000 and was replaced on the same day by plant costing 200,000. This replacement plant is estimated to have a residual value of 20,000 rands at the end of its expected useful life of 5 years. The question also tells us that our year end is 31 December 06. Thus, the beginning of the year is 1 Jan 06. The applicable normal tax rate is 30%. It was 35% in 2005 and 2004. Yes, ladies and gentlemen, we are dealing with a tax rate change. There are no permanent or temporary differences other than those that are evident from the above information. Essentially, with this question over here, what you need to be aware of is that there are three things that are happening, okay? And the things that are happening over here are, first and foremost, you have an existing plant that you're dealing with that you need to depreciate, plus you have a plant that you are selling as well as a new plant that you have acquired. So bear in mind that there are three transactions happening over here, and we need to be able to account for these three separately and accurately. So now let's go into detail with each of these paragraphs one by one, and I will take you through how you need to plot them onto your timelines. So for your existing plant, this is how your timeline will look. It's fairly straightforward. Your plant was acquired on 1 Jan 04. At this time, your total useful life was 5 years. 5 times 12 is 60 months. Then the next thing that you need to know is basically the question tells you or told you already that your year end is 31 December 06. Thus, the beginning of your year is 1 Jan 06, which means that from 1 Jan 04 up until 1 Jan 06, you've held the asset for 2 years or 24 months. Thus, at the beginning of the year, your remaining useful life is 36 months. And at the end of 31 December 06, your remaining useful life will be 24 months. Remember that your cost price is 500,000 rands. Your fair value, which the question will give you at a later stage, is 420,000 rands as at 1 Jan 06, and your residual value is null. Okay, so this information the question is going to give you at a later stage. Now, for the plant that you are selling on 1 Jan 06, plant with a book value of 140,000 rands, the tax value of which was 75,000 rands, was disposed of at a profit of 50,000 rands. And so the and part relates to the plant that you acquired in the new year, which we will cover in the next slide, but focusing on this slide over here. So remember, the question told you that all plant was acquired on 1 Jan 04. So what happens is that for the plant that you're selling, you need to now disaggregate it from the main body of information. So you've had this plant at the beginning of the year, your remaining useful life was 36 months, and in the middle of the year, exactly halfway during the year, when the remaining useful life of the plant was 30 months, you decided to sell it. Okay, so this is your information for the plant that you are selling. Okay, now the next part, or the last leg of the question, deals with plant that you acquired in the current year. We've dealt with the existing plant, we've dealt with the plant that you've sold, and the third leg is the plant that you have acquired in the current year. So the question tells you that and was replaced on the same day by a plant costing 200,000 rands. This replacement plant is estimated to have a residual value of 20,000 rands at the end of its expected useful life of 5 years. So here again, you plot that its new plant on 1 July 06, it will have a total useful life of 60 months. Thereafter, by the time you reach the end of the year, it will have a remaining useful life of 54 months. That takes us to the end of this video. Stay tuned for the next video in the series.